Good evening, class, and welcome to our performance management class for today. We are still on our standard costing and variance analysis. Today, we are going to be discussing part 5 of our variance analysis, which is advanced variance analysis. The last time when we discussed part 4, we looked at a form of advanced variance analysis that has to do with usage variance, having mix and yield variances. And we also had the sales variances that also had sales quantity variance and sales volume variance. So these are the two kinds of variance, advanced variances we had. So we said that the mix and yield variances is as a result of the direct material usage variances being broken down into their components when more than one materials are being used for production. And we said that they have to be substituted for each other so that the one of them can be compensated by the scarcity of the other. And we said that we should know the the production mix. That is important for us to know the mix and yield variances. Then we talked about the sales volume variances, and we said it can be divided into the sales quantity variance and the sales mix variances. So we talked about how these are different and how they are being calculated. So you see, mix and yield can occur in usage, in costs, and also sales mix and sales. We're going to go to another kind of advanced variance, which we will see being exhibited in production costs and also in sales volume. Now, we'll be discussing the topic planning and operational variances. So, in this part of advanced variances, we're going to be seeing the reasons for planning and operational variances. So we're going to know what is a planning variance and what is an operational variance. Then we're going to be introduced to two Latin words, ex ante and ex post. We're going to be looking at ex ante standards or ex ante budgets and ex post budgets. What do they mean? And how do they affect variances, planning and operational variances? We're going to be using ex post standards or ex post budgets to calculate planning variances and operational variances. Then we are going to be looking at how they are calculated, and we analyze more than one difference between the ex ante and the ex post standard costs. Then we look at the analyzing the planning variance. So we have a lot to cover on planning and operational variances. Then we shall then move to the second one, which is market size and market share variances. So we are going to be looking at how the sales volume variance is divided into the market size variance and the market share variance. So we're going to be seeing how we can determine this kind of variance. So these are the things we hope to cover in this final part of our variance analysis. Now let's go to the reasons for planning and operational variances. Variances or variance analysis serves to identify the levels of performance or the level of costs that have been different from what has been budgeted. So the aim is to look at what has actually happened and compare them to the budget. And when we say budget, is the flexible budget to get variances so that we can use the information about these variances to investigate what really happened that gave rise to adverse variance so that we can take corrective measures to control or correct the adverse variance. Or where appropriate, when we see that we have a favorable variance, we want to see how we got there and how we can exploit this favorable variance if they serve our purpose well. Now, it is possible that sometimes when you are doing your budget, you create a standard first, okay? Because budget is derived from standards. And sometimes you find out that the standard on which is the bedrock for the budget may become unreliable. There may be some errors, flaws in the standard. And so whatever you are going to be reporting based on these flawed standards will be unreliable to management. Sometimes it gives you an adverse variance and you'll be thinking, these people are doing so bad. Why? But you don't realize that the standard is bad. Or sometimes you may be having a false sense of favorable variance and you're thinking you did so well, but when you check it again, you are not doing as good as you are supposed to. And so there is a need for you to look at the variances again and create a more standard or more reliable standards that can be used to do variances. And so this gives rise to the two Latin words we're going to be using today, the ex ante and the ex post standards of budgets. Now, what is ex ante and what is ex post? Ex ante means before the event. That's a Latin word meaning before the event. And so the event we are talking about here is the actual occurrence or the actual reality that is the actuals that we use in our budgets. And so before the actual activity, you had a budget that predicts what is your likely results. And so that prediction where you stay before the actual event and you look forward is called the ex ante budget and or the ex ante standard, any of them. So it means that's the original standard. Now, when we say the original standard, you might be thinking that it's the fixed budget, right? It could mean the fixed budget. It could also mean the flexible budget based on the actual results. So, but because we are looking at variances, we are going to be looking at the flexible budget of the original fixed budget. So the ex ante standard is the flexible budget that was built from the original fixed budget, which was flexed or converted. Now, because we said that it's possible that the budget could be flawed, the budget could have errors, the foundation could be bad. You now need to prepare a revised budget, which is more realistic. Now you've taken away all the errors, you've fixed them, and so the standard here is now reliable. And so it is after the event that you now realize that, oh, the budget was flawed. Let us give a more realistic budget that can be used for accurate variance analysis. And so after the event, that is called the ex post. So ex post budget is also the budget. So because fixed budget is before the actual activity and flexible budget is done after the activity, that fixed budget is the ex ante and flexible budget is the ex post. No, we are looking at flexible budget in these two instances. Flexible budget based on the fixed original budget, which was flawed, is the ex ante standard of budget. Now, the flexible budget based on another budget that is prepared after the event based on the actual production. So all these two budgets we're using today are based on the actual production. Variances are usually calculated by comparing the results of the ex ante budget with our actual. So all the variances we had done in the basic variances we did before, the cost variances, direct material variance, labor rate variance, we were using an ex ante budget and comparing it with an actual result. So all the things we've been doing in part 1, part 2, part 3, and perhaps in part 4, we are using ex ante budgets comparing with a standard. It is in part 5 in this lecture that we are now introducing that the budget is unrealistic. And so there will be a need for us to draft a more realistic budget called the ex post budget, which will now be used to calculate variances. Now, this gives rise to what we call the planning variance and the operational variance. So how do we calculate the planning variance? How do we calculate the operational variances? Okay, now let's look at the operational variance and the planning variance. Ex post standards can be used to calculate variances as an alternative to the normal method of calculating variance. So now when the actual results is compared with the ex post budget. Now this is a more realistic budget. We are comparing it with the actual results. The variances you get are called operational variances. I will take that again. When your revised budget, so when I say ex post budget, I mean revised budget, is compared with the actual budget, with the actual activity, then the variances you get is called the operational variances. Now, when the ex post budget is compared with the ex ante budget, the difference between them is called the planning variance. So I will want you to look at it this way. Normally, we have standards or budgeted versus actuals, right? In terms of cost, when the standards is higher than the actual, we have a favorable variance. When the standard is less than the actual, we have an adverse variance. Now, that is the basic variance. Now, when you want to do operational variances, wherever you see standard, which is the original standard, replace those with revised standard. So wherever you see the original standard, you have to replace these with revised standard. And you're not comparing it with the actual. And so what you are getting is operational variance. When you're looking at planning variance, your original standard is still there, but instead of comparing original standard variance with your actual, you are comparing the original standard with the revised standard. So you're comparing two standards. The actuals is out of it. You are comparing two standards. And so what you get is a planning variance. So the planning variance is a measurement of the amount by which an unreliable cost or unreliable budget affects the actual results. So the extent to which an unreliable budget affects the results. And so because when you're doing a comparison between your original budget that is flawed with a more realistic budget, and you get an adverse planning variance, it shows that this is the extent to which the error or flaw has affected your budget. And so planning variances are uncontrollable, something that management cannot do anything about other than identify that they have used a flawed standard in creating the original budgets. And so planning variances are useless. They only give us information about the extent of error we have done. We only get that and compute it because we need it for reconciliation, but not for taking decision. And so if you are taking decision based on planning variances, then that's wrong. You will be taking a very wrong decision. Now, when we look at the operational variances, you are now comparing a budget with actual results. Unlike planning variance where you are comparing two standards or two budgets to see the extent of error. Now you're using a more realistic budget and you are comparing it with your actual results. And so, sorry, when you have favorable variance, it's good to say, yeah, I did it well. When you have an adverse variance, adverse operational variance, then you can blame who is responsible. So it means that these basic variants we have been doing before are all operational variances. Because at the time we were doing the budgets, we were thinking that they were accurate, they were reliable, and so we've been doing operational variances all this while. But now, technically speaking, when we say that the budget is flawed, that is when we now start using the technical term planning variance and operational variance. Now, how do we calculate the planning and operational variances? Now, we can calculate both planning and operational variances for any aspect of standard costs or budget. For example, we can calculate for direct material cost variance or direct material usage variance. So there's something called direct material cost planning variance. So that's the difference between the flawed variance, the flawed standard, and the more realistic standard. And there is a direct material cost operational variance. So that's the difference between a more realistic variance and cost or standard and the actual results. So we can have that for direct material, we can have that for direct labor, can have that for variable overhead. You can even have that for fixed overhead. Any cost variances, we can have planning and operational. In your exams, your examiner will want to calculate, want to do planning and operational variance in direct material or direct labor, or for both. And so the principle is the same. So don't worry, all the variances that you've been calculating before are to be used here. So when you know how to calculate your direct material basic variance, it is still the same thing you're going to do here. All you need to know is this. Before calculating planning and operational variances, first of all, do the basic variance. And so you have your basic variance, direct material, usage variance. For example, you calculate the usage variance actual quantity, standard price, minus standard quantity, standard price. Or standard quantity, actual quantities, standard quantity, standard price, minus actual quantity, standard price. That will give you cost usage, direct material usage variance. Basic. When you get that, you now have to convert to advanced. What do? Anywhere you see the standards, standard quantity, replace that with revised standard. Leave the actuals the way it is. So revised standard quantity, revised standard price, minus actual quantity versus revised standard price. That will give you the direct material operational cost variance. So because here you are comparing revised standard with your actuals. If you want to get a planning variance for that, all you need to do is leave the standards the way they are. But wherever you see, replace that actuals with revised standards, because you're going to be comparing original ex ante budget with an ex post revised budget. So where we have standard quantity, standard price, that remain the same. And when we have actual quantity, standard price, you will not say revised standard quantity to replace the actual multiplied by standard price. So all we need to know is when you are doing planning variance, replace all the actuals with revised standard. When you are doing operational variances, leave the actuals the way they are, but replace all the standards with revised standards. This is what you need to know in order to know how to maneuver your way in planning and operational variance. And I bet you will not miss it. Let's look at an example here. Product Z has a standard labor cost of 3 hours per unit at 8 naira per hour. So what it means here is 3 hours is required to make 1 unit. And if you are paying 8 naira per hour, so for those 3 hours, for that 1 unit, you're going to pay 24 naira per unit. During the first month of the current year, 500 units of product Z were manufactured. These took 1,960 hours to make at a labor cost of 16,500. Now, if you look at the way variances are being set, they usually give you the standards first, then they come to the actuals. Then if there's going to be a revise, you will get the revision after the actual. So I want you to know the pattern so that when you see the first things you are being given is the standard. The next things you'll be given is the actuals. And if there's any revision, you'll see it then. That's a typical way these questions come. Now, this question says, using the traditional variances, we mean the basic variances. Let us see how we can calculate the labor rate variance and the labor efficiency variance. So this is just part one revision. But I said, if you want to do your planning variance and operational variance, you must first of all do your basic or traditional variances first. That's important, even if you are not told. All right, now let's look at labor rate variance. Now, labor rate variance, we say it's a comparison between the actual labor rate with the standard labor rate. And if the actual labor rate is higher than the standard, then there is adverse. If the standard is higher than the actual, then it's favorable. So let's look at it here now. The standard hours. Okay, now the actual hours we are given in the question is 1,960 hours, right? That's the actual hours. How much is the cost? The cost is 16,500. So the cost for spending 1,960 hours is 16,500. Now, is that a good thing? Let's check the standard. If we are to spend 1,916 hours, how much should we spend by standard cost? We are spending 3 hours for 1 unit. But here it says we are spending 8 naira per hour. So since this is 1,960 hours, if we are to spend 8 naira per hour, it means that standard cost to be spent should have been 15,680. So it means that you spent more money than you should have spent. The difference is 820 naira, and that's your labor rate variance. So this 820 naira is as a result of spending more money. The rate at which you charge the 1,960 is more than 8 naira per hour. So let's even see how much you even charge. If we are to see it, it's going to be 16,500 divided by 1,960. And this feels like 8 naira 42 kobo. So you see, instead of charging 8 naira per hour, in the actual, you charge 8 naira 42 kobo. And that's what made your cost to be high. So you see the labor rate, the rate at which you charge higher, and it gives you an adverse variance. So this is like a revision for what we did in part one. Let's look at the efficiency variance. So how many hours did you spend in making 500 units? The question says 500 units took us 1,960 hours. But what should have been the standard hours for doing 500 units? So if we know that 3 hours is used to make 1 unit, multiply 3 hours by 500 units, you got 1,500 hours. That should have been used. So it means that you spent more hours when you did 1,960. So that 1,960 you use in making 500 units is too much, because you should have used 1,500 hours standard to make 500 units. So what's the difference? The difference is 460 hours lost, wasted, making 500 units. You didn't manage it well. It was not efficiently used. So it's adverse. Now, multiplying it by the standard labor rate of 8 naira, you have an efficiency variance of 3,680 adverse. And so labor rate variance is adverse, 820. Labor efficiency variance is adverse again, 3,680. naira. So when you add the two of them together, you have 4,500 naira adverse. That's your total labor cost variance. So you see here that this is the basic traditional variances, which we all know, no doubt about that. Now, in the usual course of the event, a variance might be investigated and the manager responsible for the labor rates, perhaps the HRO, will be blamed for paying too much money for the hours, sort of paying 8 naira as agreed. Why did you pay 8 naira 42 kobo for labor? So you will be blamed for the adverse variance. And perhaps the supervisor in charge of the work here would also take his own blame for efficiency variance. So how could you be wasting 460 hours? You should have spent 1,500 hours making 500 units. How come? What happened that you spent 1,600 and 960 hours making 500? So you take the blame for the variance, adverse variance, because the more hours they waste, the more money they will spend on them, because the time sheet showed that they spent this number of hours. Now, supposing that as the months went by, you discovered that, wow, the budget that you are going to be using to make variances is flawed. And because the budget is flawed, you cannot rely on it. Perhaps there is a machine breakdown and it has been returned to the supplier for correction and all that. And in the wisdom, I would say in your hindsight wisdom, you now revised the budget. And you now say that because you have anticipated this machine breakdown, instead of using 3 hours per unit in the standard that you created before, which is now seen to be flawed, you now budgeted 4 hours per unit, still using your 8 naira per hour. And so instead of getting 3 times 8, 24, you're having 4 times 8, 32 naira. So now you have created a revised budget. So you can now calculate, or you can now do your ex post standard budget based on this new cost. So this is called the ex post standard cost. So this 32 naira is now the ex post standard cost. So you can now recalculate your budget based on this ex post standard or after the event. So let's look at operational variances. So these are calculated using ex post budget. So you know your traditional variance, we were using the ex ante budget comparing with actuals, but now operational variances, we are using the ex post budget, revised budget, comparing with the actuals. Now the planning difference here is the difference between the original standard costs, the ex ante budget, and the revised standard costs, the ex post budget. I said that before. So let's look at the planning variance. Let's look at it here. Sorry, this operational variance, not planning. So operational variance is the difference between the ex post budget and the actual result. So let's look at it now again. Labor rate variance. Let's look at it this way. 1,960 hours cost us 16,500. Now that's your actuals. Fine. But now, which standard are you going to compare it with now? Of course, not the flawed budgets. going to be comparing it with the, okay, this example here, this is still being compared, okay? This is compared with the ex-post budgets. In the ex-post budget, we still have our 8 naira per hour, still unchanged. 8 naira per hour, still unchanged. And so you have your 15,600. This is what your standard should have been. And you have your 820 adverse. So you see here, 820 adverse is still the same here because the new budget still recognizes the 8 naira per hour. So that didn't change. So no problem about that. If that had changed, this budget would have changed. So you see here, the budget cost per hour had not been revised. So it means that in the labor rate variance, they didn't get it wrong. The cost per hour is okay. So that's why there is no difference between the planning variance and the operational variance. Now, looking at labor efficiency variance, now that's where you will not see the error. You see here that 500 units of Z should have taken us 4 hours each, as against 3 hours each we were talking about. So before, when we said 3 hours each, it gave us 1,500 hours. But now we are using 4 hours. It's going to give us 2,000 hours. So that's our revised budget, what the standard should have been. So how many hours did it eventually take? Eventually took us 1,600 hours. Is that a good thing? Yes, because our actual hours is lower than the standard hour. So the difference 40 is favorable efficiency variance. So we used our hours well, taking into the fact that we have used a more realistic budget. And so making our standard labor rate as 8 naira, we didn't change. We have an efficiency variance of 820 favorable. And so what do you do? The labor rate variance did not change. And so it means that the human resources is still to blame, because he paid more than the standard. So looking at the supervisor, the efficiency variance, you find out that he should be congratulated. You managed and saved 40 hours for us. And so because of that, we did not pay as much as we have planned. So well done, but for saving us 800. So that's what the the efficiency, the operational variance is telling us, that is a more realistic budget to be compared with the actual to appraise management or managers. So normally the operational variance is what is being used. So looking at planning variance, let's see what's going to be there. The planning variance is not a very useful figure, other than being part of the reconciliation between the actual results and the ex-ante cost of achieving these results. So that's only what it is good for. So when managers calculate planning variance, they just calculate and throw it away. They just know what the extent of error is, and they can't do anything about it. And so they just calculate it for calculating sake. I said before, the planning variance is the difference between two standards, the ex-ante standard and the ex-post standard. If the ex-ante standard is higher than the ex-post standard, you are going to get a favorable variance. It means that the exposed variance or the original budget was even higher. You've come down and you get a favorable variance. But if the exposed variance is higher than the ex ante, you will get an adverse variance. And most likely, when you are doing planning variances, your ex post standard is usually higher than the ex ante standard, and you are going to get adverse. So most time, 90% of the time, planning variances are adverse. If they are favorable, please don't be happy about it. If they are adverse, don't get depressed, because that is not what is being used to appraise management. Okay, so let's look at this planning variance. Let's see. The total cost for 500 units, total labor cost for 500 units. So let's see, in the ex post variance, ex post standard cost, we said that we are using 32 naira per unit. How did we get 32 naira? We said 4 hours multiplied by 8 naira per hour give you 32 naira per unit. So 32 naira per unit multiplied by 500 units, our ex post standard cost is 16,000 naira. That's the revised standard. Now looking at the ex ante, which is the original standard, we use 3 hours, 3 times 8, 24, and we multiplied by 500 units to get 12,000. So you see, it has been revised up, and there's going to always be an adverse. Planning variance, labor efficiency is 4,000 naira adverse. And so it means that the degree of error, you did not take into cognizance the error, and it leads to 4,000 naira adverse affecting the cost. It means that the ex post standard is more costly than the ex ante standard cost. Okay, so that's it. So if you look at the summary here, the planning and operational variances in our previous examples can be summarized as follows. When we did the traditional variance, which is the basic variance, we had that operational variances is what the traditional method is, so to speak. Labor rate variance, we got 3,680. Labor efficiency is 3,680, which we got. The basic variance, labor rate variance is 812 favorable. And when we add them up together, we have, it's adverse to 820 adverse. So when we add them up together, you have 4,500 adverse. So you see, under the traditional method, both labor and efficiency are all adverse. Now coming to planning and operational, the labor efficiency variance, operational, we have 820. So you see here that it has reduced the adverse variance from 3,680 adverse to 820. It means it's even better, but you still have to blame the manager for that. And labor rate variance, labor efficiency variance is 620 favorable, while the labor rate variance is 320 adverse. And then we look at the planning variance. The planning variance, labor efficiency, because the labor rates didn't change. Labor efficiency gives you 4,000 naira adverse. So when you look at everything, both the traditional and the planning and operational, total variance is still 4,500. Gives you the same amount. But you see here that it has been subdivided into planning and operational, which makes it more useful to help management take a decision. So once again, I will need to tell you that if you want to do your advanced variance, take notes. You are comparing the basic, you are comparing original standard with actuals. When you're doing advanced variance, planning and operational, if you are doing the planning, it's still your original ex ante budget, but you're now comparing it instead of with actuals, you're comparing it with revised standard or ex post. So anywhere in your formula, in your basic formula, anywhere you see actuals, you now change it to revised standard. So that's one reason why you need to do your basic variance first. Put your basic variance formula and now start doing the change. Actuals change to original revised standard. Your standard remains the same. You want to do your operational variances, your actuals remains the same, but you start changing your standard. So going back to the original budget formula, the original variance formula where you have standard and actual, your actual remains, but your standards are now changed to revised standards. So take notes of that. That will mean the difference between passing variance and failing. Okay, so more than one difference between ex ante and ex post standard costs. In the example above, only the standard usage changed between the ex ante and the ex post projects. Now, a situation could arise where both standard usage and standard cost will change. Now, when that happens, the principle in calculating the planning and operational variance is the same as before. We cannot overemphasize it. The operating variances are calculated using the ex-post standard cost, which is the revised standard, and comparing it with the actuals. Whereas the planning variance is calculated using the ex ante original budget and the ex post using the revised budget. So it's just the difference between the two budgets. Okay, so that's what we can get from that. So let's go now to another kind of variance I want to discuss. Now, this is called the market size and market share variance. So this is the last part of variance we want to discuss. Now, it is similar to planning and operational. How are they similar? Let us see. In this part, we are going to be looking at sales volume variance. You know, when we did planning and operational, we are looking at costs. Now we're looking at sales variance. So remember, last time when we did advanced variance, we did costs, mix, and yield. Then we now went to sales volume, cost, quantity, and quantity variance and price variance, and mixed variance and quantity variance, right? So now again, we're looking at volume variance, and we're looking at market size and market share. How are they related to planning and operational? Let us see. Sales volume is a function of market share and market size. if the original budget derives the budgeted sales volume from the market share, and the thing to note here is that the total market size is something that is outside the control of the company. It's outside the control of the organization. But what happens is that a company is going to estimate what the market size is going to be. In other words, they are predicting what the market size would be. They may get it correctly, they may get it wrong. It is outside the control of their management. And so market size is a planning variance. You cannot do anything about it. It's a market variance, planning variance. Whereas market share is an operational variance. It is obtained by a company, and it is using the market. The company has direct the market share, and so that's an operational variance. So let's look at this example to illustrate the market size and market share variance. Sorry, what's the name of this thing? Coloco sets the following sales budget to sell 43,000 units. So this is what the budget to sell of product Y, and budgeted to earn a contribution per unit of 20 naira. So you see here the budget is being, the standard is being set here. The budgeted sales volume is 43,000 units, and the budgeted contribution is 20 naira. They now make an estimate that the total market size, total size of the market in the budget. So they are trying to look at what could be the total market demand in the market. They now predicted it at 700,000 units. And we said that they could get it right, they could get it wrong. And they said that if they have 700,000 units, the market share for the company will be 10%, which is 70,000 units. It means that if they get it correctly and the market size is 700,000 units, they are going to get 70,000 units out of it. Wow, that's their prediction. But what happened when the actual results came to light? Actual sales of product Y in the period resulted in 58,000 units. Now look at something here. They budgeted 43,000 units. They now sold 58,000 units actuals. Okay, so total market sales or total market size of product Y, the actuals now became 645,000 units. So you see here, they predicted 70,000. They now have 645 actuals. In retrospect, it is accepted that the budget should have been based on a total market size of 645. So you see, they didn't plan well, and they now said, okay, we are going to make a sales of 700,000. Okay, they are going to make a sales of 10% of 700,000. They predicted a market size of 700,000. If they have taken time to look at some of the variables, they should have known that the market would have dropped 645. Now let's see how the traditional sales volume variance could be calculated. We said volume variance, you're going to be comparing actual volume with the standard original budgeted volume. So actual volume is 58,000 units, right? Actual volumes that was sold. What was their predicted budgeted volume? You know, someone will be tempted to say 43,000. No, here says it's budgeted to have 10% of 700,000 units. But this was their standard. This is what the standard they got to use to set this budget. So this is what they budgeted, that if the market size is 700, they're going to get 10%, and so they're predicting budgeted volume of 70,000 naira. So you see here that if you budget to sell 70,000 and you sold below that, that means you didn't sell as much as you have budgeted. So the difference, which is 12,000, is adverse. Multiplying it by the 20 naira per unit contribution, your sales volume variance now looks like 240,000 naira adverse. That is a traditional volume variance. All right, so let's look at how market size variance would be calculated. Now look at it. Market size variance shows the effect on sales or on sales volume and contribution or profits on the actual total market size. Okay, if the actual total market size is larger than expected, when we say larger than expected, it means you've predicted 700,000. And so, you know, you're going to take 10% of it. And the market size turned out to be 750. It is higher or larger than expected. And you take 10%, which is 75, you have a favorable variance. But if it is smaller than expected, as in the case we have here, 700 was predicted, you have 645, smaller, you're going to get adverse. The total difference between the budgeted total market size and the actual total market size is calculated initially in sales or sales revenue. So you calculate the market size variance first. Then it is assumed that the company should achieve its budgeted market share. That's an assumption. Then the market size variance will then be calculated. Let's look at one of the question here that is said before us. Look at the market size variance. Ex ante budget, which is your original budget, you budgeted that the market size would be 700. And then actual result, which is what you use in making your ex ante, your ex post budget, gives you 645. If you see the difference, which is 55,000, that's the difference in market size. And since you are going to take 10%, it means your market size variance in units is 5,500. Another way of doing it is take 10% of 700,000, which is 70,000, and take 10% of 645,000, which is 64,500. Find the difference, it gives you 5,500. When you multiply it by standard contribution units of 20 naira, you get 110,000 naira adverse as your market size variance. So because what you smaller than it, you find out that you have an adverse because it was smaller than expected. All right, let's look at your market share variance. Market share variance. A market share variance is calculated by taking the actual total market size, which is what we got in our ex-post or revised standard budget, and comparing it and check if the budgeted market share had been achieved. We compare it with the actual sales. So you see here now that we're also doing an operational variance. Remember, in the market size, we look at planning variance. We look at the total market size ex ante and compared with ex post variance, ex post market size. And we looked at the difference and we call it planning variance. But now in market share, we are looking at the ex post variance, ex post cost or ex post market size, which is the revised market size, and comparing it with actual volume sales. So let's look at it again here. Looking at the market share variance, the ex post revised market size, which is based on actual, we said it was 645,000 units. And we said we are going to take 10% of it. And that this gives us a volume of 64,500 budgeted. And this is ex-post budget. Comparing it with our actuals, we actually sold 58,000 units. So now we are comparing 58,000 units with 64,500. And we see we have an adverse variance of 6,500 units. When you multiply by the standard contribution, we have 130,000 naira adverse. So this is even more in adverse than the market size. So you see here that the market size variance and the market share variance add up together to give you your total sales variance. So look at it again here. Market size variance was 110. Market share variance was 130. Add them up together, you have 240 in value. Look at the units. Market size variance was 5,500. How did we achieve that? Market size, remember, is a planning variance. And in planning variance, we use the original budget, 7,000 units, that'll be 70,000 units, which is 10% of 700,000. And compared with the actual, the revised budgets. So we are comparing two budgets now, comparing actual result, which is used in the revised budget, which is 645, which gives us 64,500. The difference is 5,005. In market share variance, we are using your revised budget to compare with the actual results. And the revised budget, which is 645,000, 10% of it gives us 64,500. And our actual sales is 58. So the difference is 6,005. So that is how we do our market size, market share. So once again, market size is planning variance. And what does planning variance tells us? Something that is beyond the control of management. Management cannot do anything about it. What of operational variance? That is related to the market share. It tells us these are the things that management can control. They can take corrective measures, they can take preventive measures, they can take for control of it. They can do something about it. So this adverse variance in market share should be pinned to somebody who will do something about it. So far, so good. We have looked at advanced variances. So we've looked at two sets of variances. We look at mix and yield variance. On the one hand, with sales and quantity variance together, which is the first set of advanced variance, the mix and yield variance happens to relate to costs, which is direct material usage variance, direct material usage variance, mix and yield variances. And we looked at sales volume variance, sales mix and sales quantity variance. Then we come to find another set of variance, which is planning and operational variance. Planning and operational variance relates to the fact that budget has been revised, and we have original budget and revised budget. So in case you want to be mixing up this ex ante and ex post, you can just change those names to original budget and revised budget. And we said planning variances are not useful for us because it tells us the differences between two budgets and how the error made in the original budget has affected the costs. And we usually use operational variances to evaluate management. And we said operational variances is comparison between the revised budget and the actuals. We looked at market size and we relate it to planning variance. And we look at market share and related it to operational variance. So what I want you to do for me is to go back to this material and look at those exercises again, bearing in mind how I have told you to look at these variances and calculate them. Then get to the past questions and see how you can do questions on revised standard. I told you before that questions on variances will come, the standards will be set, then there will be budgets, there will be actuals, then you will see a revised. So follow it that way, then you would miss it. So thank you so much for being patient in class today. This brings us to the end of our variance analysis. For 5 classes, we have been dealing with variance analysis. So it means that if variance analysis comes out in your exam, you are as good as getting a good chunk of the mark. So thank you for your time. I look forward to see you again in the next class when a different topic will be taken. So on behalf of me, myself, and I will say thank you so much and have a nice day.